Hi, folks. Welcome to Ditto Insurance. I'm Shashank, your host. And today I'm being joined by Sushant, our senior program manager here at Ditto. And we will be talking about one of the top five, six, or how many ever reasons Sushant has to buy a term insurance as early as possible, even if in your 20s. So, Sushant, welcome to the podcast.
Thank you so much. I think I have about 8 reasons, so
Okay.
let's do it.
All right.
Yep.
So, Sushant, there's a saying in insurance, especially for term insurance.
Right.
When someone asks, "Hey, Sushant, when should I buy an insurance?" I think the answer everyone should be hearing is yesterday.
Right.
How apt is that?
Very apt, right? I think that's something everyone should live by and follow. Um, in fact, one thing personally that I've seen, right, off late, we are seeing an increase in a trend of financial awareness with people in their early 20s. But there's still a bit of a gap when it comes to the financial planning going really well and increasing, but the creation of that safety net, right, in the form of term insurance, not everyone's catching on to that trend, right? And I think we're here to spread the message that it's very important. It's something everyone needs, and the sooner you realize it, the better. Which is why I think that saying really does hold true.
Great. So, let's put out the message right up front. So,
Yep.
hit us with your reasons.
Right. I think one of the first ones, of course, coming to the price aspect, one of the biggest components in term insurance is the fact that you lock in the price moment you buy it. So let's say if you were to purchase this as a 25-year-old, a 1 crore term plan for a duration of about 40 years, right, till about 60, 65, will cost you maybe 10 to 12,000 a year. But should you keep delaying this, right, till you start your family, till you feel, okay, now I have dependents, maybe I'm in my 40s by now, right? The same 1 crore term plan will cost me 25, 30,000, more than double the premiums, right, of what you could have had earlier.
Right.
And you've been unprotected for so long, right? I think this thought that a lot of people in their early 20s have, which is almost of a, I'm invincible, right? Nothing can happen to me. And it's not wrong to think that, because how often do you see people of your age, something happening to them? It does occur though. You have people even in their early 20s meet with accidents or get diagnosed with some forms of life-threatening health conditions or whatever. But the percentage and probability is extremely low, which is why even insurance companies understand this and price it so reasonably.
Exactly.
But you'd hate to be in that position, right? To be one of those individuals who's just started their career, maybe just starting off a family as well when you're 25, 30,
True.
and something unfortunate like this were to happen to them. They would obviously be left with a massive financial burden, but a product like this could have really taken care of them financially.
Makes sense. So,
So,
buy early and
yeah, lock in a good price, exactly.
all
Get
right.
lower premiums and lock that premium in as well.
Perfect.
The second one being something called the incremental coverage strategy. So what this essentially means is, maybe I can better explain this with numbers.
Okay.
So let's say for 1 crore term plan for a young individual costs 10, 12,000, like I said earlier. A 2 crore plan will not cost 20,000 and a 3 crore plan will not cost 30,000.
Okay. Ideally, it should, but
Right,
okay.
fair enough. In a fair world, that's what it should, right? The point here being that, look, for a young person, there are going to be a lot of life stages coming his way in the future, right? He'll probably get married, promotions, expenses increase, income increases, and so on. Kids come into the picture, their expenses shoot up, and you know how it goes.
Yeah.
Um, so for this person, he has to obviously plan financially in advance, right? Now, what he could do is buy a 1 crore plan now, buy another one when he's 30, buy another one when he's 40, thereby taking care of all of this.
So you can buy term insurance again and again.
You can. You can even increase the existing one if you have the option. Some
Okay.
plans give you that flexibility that you can avail something called a life stage benefit.
Okay.
Or you can hold multiple term insurances provided you're eligible for it with your income.
Understood.
But
Okay.
for this young person to plan this right in advance, buy this when he's 20, 25 years old, to buy that 3 crore plan, he wouldn't have to pay 30,000. He could pay just 22, 24,000. That's how insurance companies have also offered this pricing. So for this person to plan in advance, factor in all of these future life stages, another real big advantage that he could sort of make use of. Really good prices with, like I said, the incremental coverage strategy is what we like to call it.
Understood.
Yeah,
All right. So that's the second point.
The third point I would go with is probably the age-related risks that come in, and essentially the harsh reality of what happens post 40, right? Anyone turning that age. So point here being, once again, let's say if I don't buy it at 22 or 20, right, and I end up buying it at 25 or 30, the insurance companies won't be too harsh on me, right? So let's say if I, instead of 10,000, they'll ask me to pay 12, 13, 14,000 or so. And touch wood, fortunately, hopefully, for a young person like that, there shouldn't be too many changes in his health or his lifestyle or anything of that sort. Now let's fast forward to, let's say if a person doesn't buy it at 35 or 40 and decides to push it by a couple of more years. He says, okay, maybe 40, 45 is when I'll pick this up. This person will not pay, let's say 20,000, he'll now pay almost 28, 30,000.
Okay.
So you're looking at a 40, 50% increase just in a matter of 5 years. Reason being, post 35, 40, this is again a known fact in the medical world as well, right? That the human body tends to go through changes, right? Your blood levels could start being a bit skewed here or there, right? Your blood sugar could shoot up, your cholesterol could be a bit off, there could be stress related to work, family, and so on. All of these things will take a toll and impact on your health. Now, insurers will also see this as a massive risk for them, right? That this person now is a risky profile where the chances of something happening to this person are much, much higher. Thereby, your premiums, when you apply, they'll give it to you, let's say they'll offer it to you at 28, 30,000, but post the application, post the medical checkup and all the steps, they could come back saying, hey, we want you to pay 50% more than this as well, right? Apply something called a risk-based loading charge.
Correct.
That based on our medical findings, we feel you should pay even higher than what we were initially asking for. So this is a massive risk that you're leaving yourself open to, right? That, hey, I could be at their mercy paying whatever premiums they want me to, rather
Exactly.
than what a normal individual would pay.
Exactly.
So yeah, I think medical changes and lifestyle changes that occur are a big factor here.
So better to buy in your 20s.
So the fourth point I'd like to go with is future-proofing your financial security. So what this essentially means is, for a 20-something-year-old, a lot of them don't buy this because they don't have dependents at the moment, right? That's the first question that they have, that, look, why do I need this plan? I've just started my career, my parents are still working, no spouse or kids yet, maybe I have a girlfriend on the side, but that's about it, right? What do I need this plan for, essentially? It's not something you actively think of.
Correct.
And two, let's say, okay, you have understood all the points I mentioned till now, that, okay, maybe because of medical reasons or locking in the premiums I should, how much do I take, right? I have no idea what it costs to run a family.
Correct.
So that's obviously another factor that you really can consider, and something that, in fact, even we at Ditto can help you with, right? In terms of how to calculate how much cover amount you need, what are the factors you think of, inflation. We can even help you with a rough idea on expenses in terms of what it would cost to live in a certain city and so on. And based on that, at least you can work from there and try to, look at some sort of NPV calculation and come up with a number for yourself.
Right, Sushant. And folks, just like Sushant mentioned, that here we give you an expense-based approach to calculate the right coverage for your term insurance. Now, there are a lot of nuances that are involved when you buy a term or a health insurance. So if you're in the market to, say, purchase a plan, be it health or term, we are here for you. Or if you just want to compare two policies and just talk to us, then you can find the link in the description. Our consultation is completely free for you. And you can find the link again in the description. So, Sushant, getting back, we've covered 4 points. Now, I have run out of all the other reasons. So let's hear from an expert like you. What are the other 4 reasons?
So the fifth one I'd go with is probably the hidden bonus or the tax benefits you essentially get. I think it's very rare that the government gives us financial gifts, but when you're offered one, why not make the best use of it, right? Or make the most of it.
Definitely.
So yeah, for life insurance premiums and health insurance premiums, you do have tax benefits available. For health insurance, it's under Section 80D, and for life insurance, it's under Section 80C. Under life insurance, in case you opt for a critical illness rider, which is in case of some sort of critical illnesses, you get some financial support. The premium you pay for that rider, that can be used under Section 80D as well, because technically that's a section for medical insurance and health-related insurance.
Correct.
So you do have a combination of both. And lastly, the payout that's given to our family as well, right? I think growing up, when we used to watch, at least personally, I used to have this question a lot when I'd watch Kaun Banega Crorepati with the family. I'd ask Dad that, hey, does the family actually get 2 crore?
Correct, correct.
And Dad would say, no, there's a straight 30% chunk that gets taken away.
Is it?
Yep. I mean, that's how it is, right? In KBC, the winners don't actually get the money. They lose about 30%.
They should just change it to Kaun Banega Lakpati at this point.
Fair enough. But in term insurance, thankfully, the term payout that's given to our family, the entire amount is tax exempt.
Great.
Because the insurance company, even the government does acknowledge and realize, right, that this is a financial security that our family needs, and it's unfair to take a big chunk out of it. So that entire amount is admissible under Section 10D of your tax savings.
That's pretty great.
So the next one I'd probably like to address is the discounts and competitive pricing strategy. So the insurance companies also realize and are clearly seeing that there's a huge untapped market in people in their early 20s when they're buying insurance. So of late, we're seeing a trend where they're offering a lot of discounts. For example, that for younger individuals, the prices are a lot lower. Two, they're offering discounts in terms of salaried profiles, that if you're a salaried employee, you get it for lower. Um, Three, in fact, I've seen one certain company also offering first time insurance discounts. Meaning, if this is your first life insurance ever, you get an extra discount.
Wow. Okay.
Pretty much, yeah. So, yeah, these are essentially just strategic entry points, right, for young individuals to kind of get into a plan. And it's pretty evident that insurers are literally begging young individuals to buy a plan as early as you can, right, by incentivizing you as much as possible.
True.
Yep. So the seventh point I'd like to cover is simplified underwriting and lower rejection risks. So this is a point that we have covered, I think, in our earlier discussions as well. Wherein the younger you are, the easier it is to buy a plan, right? So your medical checkup that occurs after you purchase the plan, the chances of something showing up in that are a lot lesser, right? You're a young, healthy, fit, active individual. What are the chances that you might have some blood sugar high or some other sort of level out of place?
Very less.
Very low, absolutely correct. Whereas if you're buying it in your 30s or 40s, it's natural that something like this could occur. Therefore, it's easier for you to get the plan, whereas 30, 40-year-old individuals sometimes are rejected for this reason itself, right? Saying that, hey, you have this medical history, so we don't offer you the insurance.
So can insurers reject you if you have diabetes?
They can, so it depends. I've seen cases where, in case your blood report, let's say, firstly, when you're filling up the form, they will ask you, do you have any medical history? You'll select no there because you're not aware of anything. Now, during the medical checkup, if blood sugar shows up in the test, they will send you a questionnaire. They'll ask you a few more questions that, hey, we found this was high. Are you a diabetic individual? Have you ever been diagnosed before? And if you say no, you can expect two outcomes. One is, of course, they could give you a rate up, meaning you bought the plan for 20,000, but they want you to pay 30,000, essentially 50% more,
Okay.
right? Saying that, hey, since you're a diabetic young individual, we want you to pay higher than the average person of your same profile. The other one that more commonly occurs is a postponement. They will postpone your application or essentially reject it and give you back your money. Point here being that you can reapply 6 months later.
Okay.
So their way of doing this is that, look, here's your money back. We can't offer you insurance right now. This is the reason why. Now take your time, right? Spend the next 6 months working with your family doctor, working on your health and so on. And their idea is also this, that 6 months later, when you revisit them, you might have more clarity. Was it a one-off mistake in the test, or are you actually a diabetic individual now? And if yes, what treatment have you taken? And then they're willing to reconsider.
Exactly. Benefit of doubt for both the parties, right?
Absolutely correct. So this is something that does commonly occur, and why go through all this hassle, right? Why not
Yeah.
just opt for this in your early 20s and not have to deal with any of this?
Exactly.
Pretty simple reason there.
All right.
Lastly is, I think, the financial commitment, right, that you're kind of signing up for. It's a big responsibility, right? You're essentially promising or entering into a contract with a company saying that, look, I'm going to pay you this amount every year, just continue to offer me this protection.
Okay.
So it's a long-term financial commitment that you've taken on, right, to sort of pay these premiums, make sure that this coverage is in place, and out of it, all you're going to get is peace of mind, right? You're going to get that mental peace and satisfaction that, hey, hopefully nothing happens. If it does, I know I've taken care of it. But it's a responsibility you've taken on, right? You have to pay every single year. You have to make sure you maintain good health, and yeah, things will work out.
Right. Now, Sushan, let's do a quick side-by-side comparison of the perks of buying insurance in your 20s versus in your 30s versus in your 40s. So let's do it.
So I think one, in your 20s, the premiums are lower. That's obviously probably the first point there. Two, if you have the financial eligibility, you can get a higher coverage as well, right? You can safeguard the foreseeable future and factor in expenses increasing in the future, inflation, all those things. Three, I think you're at the peak of your health, right? There is probably, in all probability, there's nothing wrong with your health. You're fit and fine, and it's easier to get the plan. And next would probably be the fact that you don't have too many financial liabilities. So it's a lot easier for you to think about this and commit a certain premium toward this, right? Rather than having to think about oh, I have that loan to pay, I have to take care of my dependents, I have to take care of other liabilities, and so on. So that aspect obviously does weigh in here as well. And lastly would be the fact that you can get a longer tenure. So you can buy a term insurance for a good amount of at least 30, 40 years or even 50 years if you'd like to. Although that's not something we recommend, but the tenure is of your choosing, right? It's not limited to what the insurance company says. A young person can buy it for as long as he wants to. So yeah, I think that's a summary of all 8 points that I wanted to cover in terms of why you should be buying a term insurance early. I think we've covered a variety of points in terms of the lower premiums you get, the advantages you could take in terms of buying a higher coverage amount, the risks you could foresee and how to kind of work around them and take best advantage of those. So yeah, I hope this was an insightful session, and we've managed to convince a few 20-plus-year-olds out there to kind of opt for something like this.
I'm sure. I think we as 20s, we in our 20s have nailed the financial, independence part. But financial safety net, well, I think they are able to achieve it after they watch this video. So thank you, Sushant, so much for joining us and again helping me out in covering this topic in detail. And folks, if you like this video, then please drop a like and subscribe if you haven't already. And the link is in the description if you want to avail a free consultation with us for your term or health needs. And like always, folks, happy insurance hunting.